Good morning and welcome to the Killik Co Market Update. The EU summit concluded, and after 90 hours of negotiations and numerous disagreements, EU leaders finally agreed a €750 billion deal to help those member states hardest hit by the COVID pandemic. Now this has been touted as a landmark deal. It's been the first time that the European Commission has borrowed money on capital markets on behalf of the bloc. The Recovery Fund is really centred on a programme of €390 billion of grants that will go to economically weakened EU member states. Now this is actually a smaller number than the €500 billion of grants that was originally proposed by Germany and France back in May. And one of the primary reasons for the reduction in size was the objections of Austria, Denmark, the Netherlands, Sweden, who were collectively referred to as the Frugal Four. They were opposed to the idea of allowing the EU to borrow money and effectively hand it out to member states. So the price for their cooperation was a reduction in the overall amount of grants payable, and they also secured was effectively a bigger discount on their budget contributions to the EU. So the summit wasn't just about the Recovery Fund. Leaders also signed off on the EU's budget for the next 7 years, which will be worth around €1 trillion in total. One point that stands out within the plan is the stipulation that 30%, so nearly a third of the budget will be of the recovery plan. The budget and recovery plan will be allocated to green policies and advancing the energy transition. So this will be seen as many as being in line with the EU's goals of reducing carbon emissions to net zero by 2050. So all in all, markets have taken the deal fairly well, and whilst there weren't too many surprises, it will potentially help to remove what some of the hurdles may be for investors committing capital to European equity markets, because it begins to solidify weaker underlying economies. One point of debate, I guess, is whether or not this deal will lead to an even greater fiscal integration, but that remains to be seen. But clearly, it will be a step in the right direction. Now, this is not the weekly chart of some biotech or a hot new startup. This is, in fact, the weekly price action we've been seeing in silver. So whilst gold has continued its move higher this week, reaching almost $1,900 an ounce, which is encroaching on its 2011 all-time high of $1,921 an ounce, as you can see, silver prices have had a big move this week. So in the past 4 days, silver has been up as much as 20%, and it currently sits around 7-year highs, around $22.50 an ounce. Although this is still quite way short of its all-time high, which, like gold, was set in 2011 at a price of $49.80 an ounce. So there's a couple of reasons for these move higher. Firstly, this applies to both gold and silver. A weak dollar, like we're seeing, and falling real interest rates has continued to add to the attraction of precious metals. And there's a lot of historical evidence that shows that real interest rates, that's interest rates that have been adjusted for inflation, boost precious metal valuations. Secondly, and relating more to silver, investors are being attracted to it for its industrial uses. So silver is used in the manufacture of things like electronics and solar panels, for example. And in fact, industrial usage makes up over 50% of overall demand for the metal. So not only does silver tend to perform well in periods of loose monetary policy, like gold, but it also tends to fare well when there's a pickup in manufacturing demand. So given global government commitments to making COVID recovery a green one, it seems likely that investors are looking to silver as an industrial beneficiary of green policies. So when we see moves like these, we're always kind of enticing speculation into the market, I guess, and silver prices tend to be far more volatile than gold. It tends to underperform when prices are falling and outperform when prices are rising. So silver is up 25% on a year-to-date basis. It fell around 35% in March, which is similar to the falls that we saw in the US stock market, but it's now up 90% since that low in March. Gold, on the other hand, same, silver up 25% year-to-date. It fell 15% in March and subsequently risen 30% since that low. So it gives you a bit of an idea as to how much silver can actually move around. And it's not just silver itself, the silver price itself, that's seen its price move higher, but we've also been seeing the share prices of those companies who might react accordingly. So London-listed Fresnillo, for example, are up over 80% since the beginning of the year. So whether or not the rally in silver prices continues clearly remains to be seen, but inflows of investor funds into physically backed silver ETFs, for example, seem to be outpacing those of gold at the moment. So it'll be interesting to see how the whole story unfolds. Finally, just to bring you up to speed on how US earnings season is progressing. So far, we've had results from a number of closely watched companies this week. And on the whole, the market's been fairly content with what it's heard. Here, we can see that around 25% of the S&P 500 has reported its their Q2 earnings so far. And you can spend a day picking through these tables line by line. But at a quick glance, we can see that around 70% of companies who have reported have beaten revenue estimates and 80% have beaten their earnings estimates. And on both measures, by more than historical norms. It's obviously important not to forget that given recent events, companies have struggled to forecast levels of business activity and guide accordingly. So perhaps we shouldn't read too much into this just yet. In fact, when we look at the growth numbers, we can see some of those challenges front and centre. So only 36% of companies, for example, have beaten their estimates of revenue growth, and 27% have beaten forecasting earnings growth. But again, this shouldn't come as a surprise, as it was widely touted. We knew all these things. So it's still early days for earnings season. There have been some real bright spots, but on the whole, so far, things are going okay. Looking ahead to next week, earnings season continues in full steam, and just looking at the calendar, there's clearly an awful lot to digest. That's all from us this week. Have a great weekend.